Well, look at that. Netflix is down over 3% in after hours, and you're going to be shocked when we go over this report. Netflix reported first quarter earnings that beat across the board on Thursday, with another 9 million plus new subscribers added in the quarter. However, disappointing second quarter revenue guidance dragged the stock more than 3% lower in after hours. Check this out. This is mind-blowing, actually. Netflix recorded net subscriber additions of 9.3 million that beat Wall Street's consensus estimate of 4.8 million. This was almost a 50% beat on subscribers. Now, why is Netflix stock down here in after hours? Well. You almost have to laugh, okay? Netflix guided to second quarter revenue of 9.49 billion, a miss compared to consensus estimates of 9.51 billion. They guided lower essentially by $20 million. And the stock is down between 3 and 4% currently in after hours. Guys, I've pointed this out over and over and over again throughout the last week. First, it was ASML. I thought the stock was going to fall. Next, it was TSMC. I thought the stock was going to fall. And here today, it was Netflix. And I thought the stock was going to fall. I said very clearly, not because I'm expecting bad earnings. None of those companies really had bad earnings. ASML was the worst. But none of them were really like bad earnings. You didn't see any disasters necessarily across the board. But why did I think they were going to fall? Now, I'm not patting myself on the back by any means. This has a point. I'm making a point here. Because these stocks were trading at or near all-time highs. Expectations were too high. Even if you beat, prime example in Netflix case, subscriber numbers by 50%, higher than Wall Street's consensus views, if one thing is not as great as expected, you're vulnerable to fall. Let alone if you just outright miss on revenue or EPS. If you're trading at all-time highs, or if you get bad guidance and you're at all-time highs, you can kiss your stock goodbye. That's the point here. The problem is, for broader markets, is the stocks that have carried the markets higher in 2024, they are the ones at all-time highs. They are your big tech names with the largest market cap weighting in the S&P and the NASDAQ. Stock like a Netflix has an outsized effect on your other big tech names. Especially, I think this is a safe assumption, the first couple of earnings, those big ones to start an earnings season, are a little bit more important because they can kind of tell you how the rest of earnings season is going to go. And so far, they've all been red. All of them. Even the banks were red. It's not off to a pretty start. Here in after hours, Netflix being down 3% is dragging down the triple Qs about 0.1%, and I think the selling is going to get a little bit more extreme here in the next week or two, especially when you do get Microsoft and Google and Amazon and all of these other stocks people have been super bullish on. Meta, for that, Meta is a prime example of that. Over the past, couple of months, they're set up for disaster, and I think the way to look at this earnings season is companies with high expectations, with stocks trading at near all-time highs, they're probably going to fall. You really have to impress investors for your stock to go higher and break out of all-time highs. If you are a company that is or has not been doing well in 2024, odds are your stock's going higher after earnings. And I think that is the simplest, most effective game plan for earnings that I am seeing right now. And again, unfortunately, the names that have carried the markets higher are sitting at close to all-time highs with super high expectations. And if they fail to deliver, then the carnage will get much worse for the broader markets. But Netflix, that's a pretty rough start. Even though numbers were good, and if I was a shareholder of Netflix specifically, I would be very happy with this report, beyond happy with that subscriber number. Holy moly. It's not good enough. It's just not. And I think part of that and what's going on right now is you have this rise in the 10-year treasury that's just went absolutely parabolic. 10-year treasury yield sitting at about 4.63%. If you're rounding here, you're going to round up to 4.64%. That doesn't give you a lot of cushion to not impress investors. Because if you can make almost 5% in a 10-year treasury, I mean, you got to be putting up some good numbers. You got to be putting up some good growth, something, okay? As we get closer to the Fed, maybe cutting rates, as long as it's for the right reason, then you'll probably see stocks start to perform better in that regard. But at least for this earnings season, the next 2 or 3 weeks, markets are probably going to fall quite a bit from here. Now, on the NASDAQ, you have really started to fall quite a bit. You are actually approaching your 100-day moving average here at $421.79 per share. If you break under that 100-day moving average, which, I mean, judging off of Netflix earnings, if next week's earnings are, even worse than that, which is definitely possible, then you're going to fall all the way down to that 200-day moving average. There's not a lot of support from here until that 200-day moving average. And I think a good flush out in the markets is what's starting here. I mean, this is a faster decline than what you've seen during the peak of the markets in July of 2023. This was ultimately a 10% correction during this. And you're already falling at a more aggressive pace now than you did then when that correction was starting. I don't know if that is a science that means we're going to fall 10% or we're going to fall more than that, but it's definitely not a good sign so far. If you take a look at relative strength for the NASDAQ, you're sitting at 35.47, so you're getting pretty close to being oversold, and I would expect to see a bounce. Again, next week, you're going to have your big tech earnings. Let's say Microsoft or Google report on Tuesday. If they report good numbers, great. Markets might rally on Wednesday. If coming on Thursday of next week, Apple misses and provides bad numbers, well, the markets are going to get back to business as usual, and business as usual lately is, well, markets falling. So in other words, I am expecting a bounce here in the relative near-term future. But let me just tell you, if next week's earnings are just outright not good from big tech, which we have some pretty strong signs that Apple's earnings are going to be not so good, like Apple reducing the amount of interest they are paying on their savings accounts, canceling the Apple Car project, bunch of other signs there. Even what TSMC said today, they said smartphone sales and computer sales for their chips are just not great. That directly had a negative impact to Apple, and I think Apple's a little bit better priced for bad numbers. But in the grand scope of things, Apple's expensive, Microsoft's expensive, all of those names are expensive. They cannot disappoint. And that's kind of what it's looking like. You're going to get some disappointments this earnings season. And the only kind of bull thesis left for stocks, inflation's not coming down as fast as we thought. That's clear. The Fed's not in any kind of rush to raise rates. Fed Bostic just said today that he expects to start cutting rates way later in the year, and that's obviously paraphrasing. He said later in the year, like towards the end of the year. Markets are currently expecting September, and if we're getting the first cut in September, it's going to be a while here before any kind of easing of Fed policy gives markets a bullish reaction. The only bull thesis is earnings are going to come in good. Earnings? They are coming in good. But the expectation is they're going to come in really good, and they're not coming in really good. You did also get this news today that March home sales dropped despite a surge in supply, and you can see the median price of an existing home sold in March was $393,500, up 4.8% from a year before. Now this back at the highest point was like $430,000. So real estate is starting to come down. There's starting to get a little bit more talk about maybe the wealth effect could start to be minimal or less from real estate. I don't think that's going to have much of an impact unless prices do continue to fall. And let's be honest, if the Fed maybe doesn't cut rates at all this year, well, home prices could start to fall a little bit more, and that's something to be watching for. Coming tomorrow at 9:30 in the morning, you are going to get Fed Goolsbee that will be giving a speech. Now, judging off of what we heard from Bostic today, different Fed officials say different things. Some are, more dovish, some are more bearish. Fed Bostic tends to be a little bit more dovish, but the comments he shared today were quite hawkish. Fed Goolsbee tends to be a little bit more on the hawk side, or a little bit more in the middle. Now, whatever he says tomorrow could have an effect on the markets. Fed Bostic's comments had an effect on the markets, but I think you're pretty well priced for any negative Fed narrative, as we're now expecting the first cut in September, as well as only 2 cuts in this year, and barely. I mean, you're pricing in a cut in September, and then you're pricing in a cut in December. So barely 2 cuts in 2024. We do have some earnings tomorrow morning with American Express, P&G, SLB, WePro, Fifth Third Bank, Huntington Regions, and Lakeland Bank. None of those guys are going to be too important. American Express can be if they have good or bad numbers. It's going to show maybe people are spending more money, or maybe not. And again, that's kind of the main thesis of our markets right now is people are employed, they're going to continue to spend money, and that's going to drive earnings growth. Here you can see via the AI Investor Sentiment Survey, the bears definitely starting to pick up some steam here. Bulls are trying to hold on, but the bears are definitely picking up some steam here. You do have this actually came out yesterday on April 17th. You have 38.3% of investors who are bullish, 27.8% of investors that are neutral, and the bears really picked up from 24% to 34%. That was a 10% jump in the amount of investors that are bearish right now. And unfortunately, again, for the bulls, for the perma bulls, you're probably going to get some more downside in our markets. And I think you're going to have some better buying opportunities. And if you are someone that is just itching to buy stocks right now, you really want to go for those quality names that have sold off in 2024. A lot of those are going to be interest rate sensitive, smaller cap, mid cap names. You just got to pick the quality ones, the ones that are generating free cash flow, that are just beaten down because of maybe being an interest rate sensitive name, or just because they're a smaller mid-cap stock and the money is pooled to big tech. That's the area that I'm looking at for upside surprises coming this earnings season, but I don't think it's going to be in big tech. So if big tech falls, that likely means the broader markets fall as well. Now, does this turn into a 20, 30, 40% crash from here? Well, there's a lot of room for extended downside from here. Clearly, if you pull up the weekly candlestick chart like I have here, there's definitely a lot of room for some downside. Just to theoretically, which I don't think is going to happen, but theoretically get back to your 2022 lows, that would still be downside of about 40.5% from here. Again, I don't think that's going to happen. You would have to see some kind of disaster. But, for markets to fall another 20% from here, that would put you back to October, November lows. That could be possible. If earnings come in bad, maybe geopolitical tensions continue to ratchet up. Maybe Israel retaliates against Iran and Iran retaliates back. There is a chance that you could get a much steeper sell-off than just earnings coming in okay and the market's falling, right? I'm actually not forecasting a 20% drop from here. I think most of the drop is probably over with, maybe halfway. I think reasonably speaking, you could be halfway done with this sell-off. And if you have sold off from the highs till now, about 6%, that means if you sell off, let's call it 12% total, which was my initial projection for the NASDAQ, in between 11 and 13%, we would sell off. But if you sold off another, call it 6% from here, 6.5%, that's going to put you roughly back to that 200-day moving average. I think that is a good level to really start doing some serious buying if you wanted to own your big tech names. But you also want to watch out for economic data. If it does start to look like people are losing their jobs, that's again going to crush the narrative on why investors are bullish right now, right? People are bullish, people are spending money, and that's going to drive earnings growth. If people start to lose their jobs, if you get a bad jobs report, whenever that happens, eventually we will get one, I guess when we get one, I would expect more fear to come back into the market. So I think in the very near term, earnings going to be a downside catalyst. And then the question is, does the economy hold up? What's inflation like? I don't think inflation matters all too much. We've seen in 2024, inflation has come in hot and stocks have still rallied. I think it was 2 months ago, the CPI report came out, the one for February, and it came in hotter than expected, basically across the board. And the NASDAQ went up like 1.5% that day. So it doesn't even matter necessarily what inflation does, because the Fed, they're not talking about hiking rates right now. Now, if inflation does come in super hot over the next couple of weeks, the next report we get should be the beginning of May, around May 10th. So in the grand scope of things, about 2.5 weeks from now. That's another potential catalyst for some downside if it just does come in really hot. You do have the S&P or SPY here on StockTwits with sentiment that is extremely bullish at 78. That's another thing that I look at to say retail is still very bullish on markets. That means you could probably fall more from here. But then I look at the fear and greed index, and this is probably another reason why you could get a short-term bounce here if, let's say, Microsoft earnings are good on Tuesday of next week, or another big tech company reports just really good earnings. That's not really my expectation, so I struggle with this. But I think where you're getting right now, you could see a bounce because there is some fear starting to build in the markets. Right now on the CNN Fear and Greed Index, you're sitting at 34, which is fearful. It's about halfway between extreme fear and neutral. So you definitely could get more fearful from here, and most of 2022, for an example, you were sitting in the extreme fear most of the year, so it could definitely get worse from here. But judging off of, I think a lot of people are still bullish overall in our markets. You want to be watching for a sharp kind of short-term bounce, preceded by then more downside. You did have the percent of stocks today above their 50-day moving average declining another third of 1%. So a third of 1% of all stocks fell under their 50-day moving average today alone. You have less than 27% of stocks currently trading above their 50-day moving average. So numbers just, that doesn't look good. Okay, back during your October, November lows, at the lowest point, you were sitting at about 15% of stocks above their 50-day moving average. So you're getting pretty close to that. And I do think, again, a lot of your stocks out there, your small mid-cap stocks, interest rate sensitive names, they have already sold off so much in 2024 because you went from pricing in 6 rate cuts to now barely pricing in 2. They've already felt a lot of the pain. And that's why I'm bullish on that area of the markets for specific company earnings, like a Tesla. Like that stock could rally huge on earnings if they give us any good news at all, because the sentiment is super low. That's kind of what I'm getting at here. But a Microsoft, am I going to bet the stock's going to rally big after earnings? Absolutely not. It's trading at all-time highs. Same for Amazon. Same for even Google, for that matter. Could Apple bounce after earnings? Maybe, but I think Apple's numbers are going to be probably worse than markets expect. So I don't know, just sharing some thoughts here. Let me know what you guys think down below in the comment section. What do you think is next for our markets? And also keep in mind, some point in 2024, you're likely to get some recession fears come back into the markets, and that's what gives you a larger kind of crash. And that at that point would probably prompt the Fed to start reducing rates. And again, if geopolitical tensions do pick up and you do see a shock to oil prices, to gas prices, you're going to get a lot more pressure on the Fed to also start reducing rates, because the Fed is keeping things very restrictive in their respective markets. Auto markets, financing, lending markets, home markets, right? Mortgage markets. It's very restrictive in those markets. Not so much in the broader economy. The Fed raising rates does not dictate whether or not you take your family out for pizza or, go to a restaurant or see a movie. There's just things the Fed can't touch. But if the price of gasoline goes up, yeah, that's another added input cost to every single driver in the US. And I think that could actually prompt some large rate cuts from the Fed. We don't have any significant updates on that front, but if we get any, I will definitely keep you posted. In the meantime, hit the like button and subscribe to the channel. Let me know what you think about this information down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.